What is up everybody, welcome back to another options trading video, and today is all about trying to achieve over 20% in beating the S&P 500 with minimum risk. So the agenda for this video is we want to do a safer option strategy to hopefully beat the S&P 500, which is over 10% annual return. This particular video I'm going to show is going to be over 20%. I had another video that showed how to get over 100% gains in a year, but that was trading on high volatility stocks. That is not a good long-term strategy for building wealth and carries with it high risk. So how does this work? We're going to be looking into PE positive company stocks, therefore mainly value stocks. I'm also going to talk about the initial investment, the time period, and the numbers behind the maths. And this is just a wheel strategy, but we're doing it on non-volatile positive PE companies. And because I'm still relatively new to options trading, what I do is how I find my companies is obviously I watch other YouTube recommendations, but I also do my research on top of that. And I also read other financial media on telling me what are good value stocks to buy currently. So the first topic is how do we find which value stock to do the options trade in. So one of the easiest ways is to get recommendations from financial media. Obviously you don't take their word for it, you still do the research, or companies in fields that you like. The next part is to do technical analysis to find the support and resistance levels. This will tell you where your strike prices are going to land. You then have to look at the fundamentals of the company and make sure that the outlook is still good and nothing has changed. If you've been a viewer of mine, you'll notice that I usually go to about 3 or 4 websites just to have a quick look. One of them is Simply Wall Street, and then I have a look at the summary and all the other tabs that it has there. Then I go to Benzinga and have a look at the analyst ratings for the company and their price targets. I then head over to TipRanks to have a look at their price targets as well, and then any other news that they have there. If these 3 or 4 websites say the company is generally fine, I then have a look at the actual company's investor relations page and read through the company guidance. So once I've checked that the company fundamentals are okay, I then start to track the company over the coming weeks. So unfortunately with options trading, because you can do weekly to monthly trades, you do have to keep looking back at the company and just make sure it is alright and find news about them just to make sure it's healthy. So for today's video, we're going to be using ON Semiconductors as our value stock, ticker symbol ON. So I'm going to show you how to start the run the wheel strategy on stock. The first question we have to ask is, do we have 100 shares of them already? If not, then we want to sell a put option. If we do in fact already have 100 shares, then what we do is we do the second half of the strategy, which is sell a call option. From this point on, we have to pick a strike price which we're comfortable with, and then we go ahead and then calculate the returns and the outcome. So before we go to the actual breakdown of the numbers and the maths, we do have to go through a couple of options. Now I'm already going to assume that you're familiar with how to do put and call options because I've explained them before in other videos. If not, I'll put a video up at the end of this video to show you examples of that. So let's say we do a put option on Semi. So there's a couple of factors that can happen. So when the share price goes lower on expiry date, there's 2 options that can happen. One, you either get assigned or you can roll the position out. So if you get assigned, you just pay for 100 shares for the put strike price that you placed it at. Or if you don't want to own the shares yet, you can roll further out into the future if you think the share price is going to come back again, either for a profit or to break even. So if the share price does keep going lower, you can roll further into the future and think long term so that the stock price can recover, but you are going to get into trouble. So you do need to have a entry and exit strategy for those. Now with the second half of the strategy, the call option, if the share price does go higher than your strike price, then obviously your shares are going to get called away from you. If you don't want the shares to be called away from you, you can then roll your option at a higher strike price and more into the future. Rolling will then lock in your profits and keep your shares. So now we're currently in Interactive Brokers in my paper trading account just to show you guys how to do a put option on Semi. By the way, if you're interested in Interactive Brokers and you need a referral link, feel free to have a look down in the description. So now that we've got on Semi, we put the ticker symbol here. I go to new window and then look at the options chain to have a look at the put option strike prices. So today's date is the 3rd of April in New Zealand, and therefore the market is closed, but the current price of when ON Semi closed on Friday was at $59.70. And so what I do here is now trade monthly options to do my put option strike price. Because ON Semi is quite a value stock and doesn't move quite a lot in a month, I usually feel comfortable getting assigned 10% of its price. So what I'll do is I'll have a look at the current price, which is, what is it, $59.70, and I'll multiply that by 10% down a little bit, so times 90, which gives me a price of about $53.73 or around about $54. So I'll then have a look at what the strike prices are, and we can see that I am under put, and we can see the price is $54, and here they're paying between 85 cents or $1.50. So let's just click that, and what we want to do is goes to the order page. So the expiry date is the 29th of April. So that means that on the 29th of April, if the share price is $54 or lower, we then have to buy 100 shares of OnSemi. So we want to make sure we're selling, because we're setting up the contract to say that, hey, if the share price is $54 or lower, we're going to buy 100 shares. But in order to do this contract, we want to get paid a little bit of money too. And if the share price doesn't go lower than that, then obviously this contract will expire worthless. But remembering that because we sold this contract for a little bit of money, we actually get to keep that no matter what happens. So now that we've chosen our strike price and the date of when it expires, which is 26 days from now, we then have to put a price. So it's telling us between 85 cents or $1.50. So if we go in between the middle, what's the middle of that? Let's just calculate that, which is 85 cents, take away $1.50 divided by 2, gives us that plus 85. So it's about $1.17. So if we go here and click $1.17, well, let's say we want to get filled at $1.20. So then we go ahead and click good to close. We only want one contract of that because we're only buying 100 shares at $1.20, and then go submit. So on this page is the order confirmation, and this is just telling us all the details that we've put in. Even though it was $1.20, it's times 100 because it's an options contract, so we're buying 100 shares, therefore it becomes $120 US that we're going to get paid at whatever happens. So whether or not we buy the shares or it expires worthless, we still get this money in advance. There is a little bit of commission in there, so we only get probably about $119 in the end. So from the screen, we then go on to trying to work out what the return is going to be for this month, and we then multiply it for 12 months to get the annual return. So to work that out, we then go $120 divided by the strike price, which is $54, times that by 100, and that gives us 2.2% for the month, and then we multiply that by 12. So this here, if we were to do this deal and we were to do it for 12 months in a row, would yield 26.7% annual rate. So this number is just a guidance for us of whether or not the deal is going to be good to take. So in summary, basically we're getting paid $119 to take this options up. So you would need a capital of $5,400 for this trade to be able to get 26.7% return a year. So let's say I have 100 shares. Let's now do a call option to see what prices we get. So we'd go to OnSemi, go click new, and then options chain, and we'd obviously have to go to the same date. So let's have a look at a month out, which is 29 of April, and then instead of a put option, we then change it to calls because we now have 100 shares. Okay, so the share price is still the same, $59.70, and what we do is we do the same thing again, get 10% from where the share price is to sell our shares. So to work that out, we would just go with $59.70 times 1.10, which is 10%, which gives us a price that we want to sell it for about $65. So let's have a look here on the options table where $65 is. So $65, and we can see that it sells for about the same price, between 90 cents and $1.35. So we confirm it up here on the 29th of April. If the share price is $65 or higher, we will sell our 100 shares. And so we're selling a call option, and we can see that it's between these two prices here. So it's between 90 cents to $1.35. So let's work out what that is. So $1.35 take away 90 cents divided by 2 plus 90 cents. So therefore the middle price is about $1.12. So having a look at $1.12. There we go. So now let's calculate the returns for OnSemi for this call option. We would go $1.12 divided by $65, which was the capital we needed, multiply that by 100, and then you times it by 12, which is how many months there is. So you can see here that the annual return rate is 20.7%, which is still very good. So just to summarize some of the things you learned, you get paid more money doing put options than you do doing call options. You're trying to make passive income from these options while it's trading flat on the share price. And a few important key takeaways is that you should only do options on the stocks that you want to own, because you're eventually going to get assigned those shares. Before getting into any trades, you should have a clear and defined entry and exit bullshit strategy. It must also be a company that you believe in long term, which means that you've done some research on the company beforehand. You want to be able to stick to your plan, because that way you can always make a return on your investment if you do. And while sticking to a plan is easy to say, it's actually really difficult, and that's how a lot of people end up losing money in options, because they keep doing this, and what they want to do is speed up the process and earn more income. And what happens is they go into riskier stocks instead of just staying around this 20% mark and beating the index. They want to start going for those 50 to 100% gains in 1 year. Because you're trading in options compared to a normal buy and hold strategy, this does then allow you to be able to exit trades at a smaller loss if things really go wrong. One of the main reasons that I decided to do options trading over dividend investing is because that the options premiums actually pay more than dividends. You need to have high capital to buy into dividend companies to get a decent dividend back, where premiums can actually pay you a lot more return for your money than dividend stocks. Well, that's enough for me today. Thank you for watching. So that video is just to show you how you are able to beat the S&P 500 and return 20% on stable value stocks. I am, however, still new to options trading, so I still find myself breaking those same rules. It is pretty difficult to be able to implement these and get the 20% return doing options. If you want to hear more from me midweek, feel free to follow me on Instagram. I'm also over there. I post trades and also financial news during the week. The trading platform I use is Interactive Brokers, Hatch Invest, Stake, and Sharesies for individual companies, and I use Investnow for index funds. If you want to start investing, you can use any of my referral codes down below to start your own investing journey if you are from New Zealand. With that said, thank you again for watching, and I will see you in the next video. Goodbye.